You know, if you take art classes in college, you talk about composition and technique. The new Fed buzzword, in my opinion, after today is going to be composition followed by duration. Why is composition of the Fed's portfolio, which, by the way, that sensitivity or duration pre-crisis of the Fed portfolio is 4 years. It's currently right now at 9 years.
Right.
And all the debt of the Treasury out there has a sensitivity or duration of 6 years. Let's talk composition, Mark.
Okay, absolutely. Well, Chairman Powell has said that as soon as they decide on what the ultimate size of the balance sheet is going to be, they're going to move to the debate about what the composition is going to be like. In almost any scenario, they want to shorten up the maturity of the balance sheet, and they view that as storing up ammunition for the next recession that comes along, so that if they're at the lower bound, they have a way to stimulate growth. And so before the 2008 financial crisis, the duration on the balance sheet was pretty short. Right now, they hold no T-bills, and in almost any scenario, they will go back to holding more bills. And then they have the debate about whether or not the holdings on the rest on the notes will mirror the Treasury outstanding stock or be actually shorter than that. And therefore, when they get into a recession, they can take duration out of the market, hoping to stimulate investment in housing again.
So basically, we learned two things today. By how they concentrate on composition and duration, and viewers, it's just the sensitivity. If your portfolio has a duration of 9 years, it's sensitive to movements on a basis point where the movement is a 9-year security. So what you're saying, Mark, is we've also learned or thinking about using maybe QE again, because by extending duration and dealing with the purchase of long securities, they get more stimulative bang for the buck. Is that correct?
That is correct. They are thinking a lot about what their tools are going to be in the next recession. QE is one, but also they've started to talk about interest rate caps, similar to what Japan did, which I think is a pretty important development as well.
Now, let's take a look at this from an investor strategic standpoint in the little time we have left. If this is now the conversation after what is largely regarded as a neutral pause, is it safe to say that the Fed really is now thinking much farther down the road about how much insurance they have and how they can use it best if they need it again? That certainly sounds like a Fed that's very content to stay as is for a while. Your final thought?
That is absolutely true. I think they're very content where they are, and they're thinking about their next big job, which is the next downturn, and how they're going to be ready for that.